All right. So good afternoon, ka-OJ, traders and investors. Welcome to this week's market strategy update. 1 hour a week to help you guys stay on top of markets that we cover. Before anything else, we'd like to start with a very important disclaimer. Anything here, any advice or information or details presented here should not be treated as investment advice, but rather for information purposes only, right? So with that, let's start with this week's market strategy update. So this week's market strategy update is relatively straightforward. So the title is, as we've been bullish since July 13, pretty much almost a month ago, markets that we are focused on are currently now at key resistance levels. In fact, a confluence of important resistance levels. And my at least what the work is saying, what our process is saying, is that we expect some short-term volatility from a major probability point of view, a wave 4 kind of base, a shallow base that will retrace 236 to the 382 before same major probability pointing to a bullish picture come mid to late September and all the way to Q4 2022. So with that, as always, we'll go through a market strategy update, looking at crypto, US, and Philippines. For those of you who are new to the market strategy update, the reason why we focus on US is because Philippines and crypto basically just follow the risk-on, risk-off path of the US with a close to 90% correlation. Crypto being the one that leads the US as the canary in the coal mine, and PH as a lagging market in the risk-on, risk-off picture. So we'll go to that later. We'll go through the technical and macro picture update based on the bullish investment thesis that we've presented last July. And lastly, we'll go to how to keep to strong issues, emerging crypto trade opportunities that we'll tackle at the last portion of this presentation, coupled with an Ask Me Anything come 6 to 6:30 p.m. So with that, let's begin. Just to summarize, as we began our market strategy update last July 13, Wednesday, we actually presented a case for a major cyclical turn in markets, particularly in cryptocurrency as the leading market, as the canary in the coal mine that would eventually lead US indices and eventually the Philippine index. So this is July 13, Wednesday. If you were here at the same presentation, then you know that last July 13, we already presented an overview, an overriding or an umbrella bullish investment thesis that suggested that we are already risk on for crypto. Following July 13, we presented the following weekly strategy update, July 20, a risk on view for the PSEI on the US, PSEI and the United States, meaning US equities. So these are the following moves that happen after those risk-on calls. This is the Philippine Stock Exchange. That was July 20, where the green bar is. And then this is the US as it crossed the 50-day on July 20 as well. So obviously, every market strategy update, we continue to track the components of that bullish investment thesis that we presented last July 13. And the reason why we track the bullish investment thesis is because any investment thesis or trading thesis or risk-on, risk-off thesis that you call for the market is always a dynamic and working investment thesis, right? Obviously, the reason why we want the reason why we identify cyclical turns in the markets is to be able to identify runways or trends wherein we can apply our setups, our system, and therefore, after applying our setups, to be able to hold through those runways. Why? Because it is really in the holding that really makes the money, not in the buying and selling, as as you guys remember from the Livermore quote. So this is the investment thesis presented last July 13. I'll be going through each single point and an update on each point, right? So the first thing we presented was a bottom-up picture, right? So we said that leaders were already past their lows. Plus, we were lacking a follow-through day in the NDX and the S&P 500. However, we said that there were already leaders in the cryptocurrency market that served as canaries in the coal mine. So we'll go through number one first. So we said that last July 13, bottom-up leaders were already past their lows. In fact, as the index last July 13 was making a lower low, we already saw that the index, or so not the index, but pardon me, but leaders, leading equities and cryptocurrencies in particular were already making higher lows. So we pointed out Uniswap, we pointed out Matic, we pointed out Lit, and we pointed out other cryptocurrencies that were already starting to lead the way as a canary in the coal mine. So this is a chart from Mark Minervini, and it shows you, and the reason why we start with the bottom-up picture is because the insight is that in major turns in financial markets, the insight is that leaders will always lead the indices by a time frame of weeks, sometimes a month or two. And this is precisely why, yes, we look at the index, but we acknowledge that there will be leaders that will be moving ahead that, as we pointed out, will look like weirdos that will eventually turn out to be leaders once the full market turns its way. So this was something that we noticed, the most important thing that we noticed. And it also helps a lot that guys that we follow who are pretty much the top guys in this kind of analysis, guys like Mark Minervini, Mark Ritchie II, were already pointing out that leaders were already moving past the lows and leaders were already cited during the last July 13. So we applied that same principle and insight to crypto markets, and we found out that crypto markets, as an even more leading market versus the S&P 500, was exhibiting the same thing. And that's precisely the first point of our bullish investment thesis. So as an update to that bullish investment point, since then, it's been a month that's passed by, we've seen the soldiers, meaning the overall market, follow the generals, being the leaders already. In fact, there are some charts that caught my attention with regard to this bullish investment thesis point. This is a chart from JC Parrott's of All Star Charts, and he points out that 90% of stocks, this is in the S&P 500, are already above the 50-day simple moving average. Not only that, 100%, almost 100% of all the sectors in the US market are already above the 10-week moving average. And he further points out that we've had 5 of those instances during the last 5 years. To the left of your screen, just focus on the vertical red bars. You'll see that you had one in 2019 that was right before the Powell pivot. You had another one in 2020. This was after the large stimulus package was released by the Fed due to the COVID crisis. And then the last red bar you'll see there is after the November 2020 elections, as another fiscal stimulus package was released, right? And right now we're seeing the same thing where almost 100% of the sectors of the S&P 500 are, or of the US stock market, already above the 10-week moving average. This shows, why is this important? This shows market breadth, right? Because one of the things that we would have been concerned about was indices leading the indices moving higher, but only being participated by a few handful of issues. Why? Because these kinds of narrow advances are what define bear market rallies, right? And that's not what we're seeing from a breadth point of view. From an individual stock point of view, you'll see that 90% of stocks or 92% of S&P 500 stocks are already trading above the 50 simple moving average, right? And the reason why I point this out is because there's been a lot of talk, obviously coming from the lows, that's always characterized by climbing a wall of worry, because there's still a lot of cash on the sidelines that are still net bearish, that are still net short in markets. And coming from historical precedents, 2000 to 2002, 2007 to 2009, which were the last bear market rallies, never in these bear markets did you see more than 90% of stocks trade above the 50 DMA, right? So this actually helps assuage concerns that we are currently in a bear market rally. Rather, this confirms further the number one subpoint number one in our bullish investment thesis, that the S&P 500 bottomed last June, and it's now moving towards a new all-time high. And if you guys were here during the last market strategy updates, the current pattern that we're tracking is really a terminal diagonal all the way till 2023. More on that later. Following with a breath, if you look at the internals of the S&P 500 or the rally that we've had since the June low, it's very important to note that for the last month, the rally or the risk-on move that we had was pretty much led by the cyclical components of the S&P 500 versus the value or the defensive inside or sectors of the S&P 500. Why is this important? Because if you look at what Stan Druckenmiller said, he said that the best economist that he knows is really the inside of the stock market. Now, what this means is that if the defensive sectors were rallying, if the value sectors were rallying, then that would pretty much suggest that we were in a bear market rally, or that we were in a market that we should be really defensive. But what is leading the market? We're seeing semiconductors, we're seeing biotech, we're seeing cyclicals that perform the best inside bull markets. And that's already a very nice tell and supportive of our bullish investment thesis that we presented last July 13. So far, so good with respect to the inside of the stock market. And this chart over here shows you the Russell 2000, where we divided the growth stocks from the value stocks, and it shows you that the growth portion of the Russell 2000 is outperforming the value portion. Now, from another bottom-up point of view, this is another interesting thing I saw. And this week, or yesterday to be specific, it's very important to note that both the Dow Jones and the Russell 2000 are already above the 200-day moving average, right? So they're above the 200-day moving average. If you look at the S&P 500, the S&P 500 tagged the 200-day moving average resistance last night. This is the simple moving average, with the NASDAQ still minus 2.94% from the 200-day moving average. And this is important to note. Why? Because as Mark Ritchie pointed out, I think this was yesterday or 2 days ago, he said that with the Dow and the Russell 2000 both closing above the respective 200-day simple moving average, it's very important to note that in past bear markets, right, every time the simple moving average would break, it turns down. Every time the indices would break below the 200-day simple moving average, bear market rallies pretty much stopped, or it was the maximum stopping point for a bear market rally. And the fact that just yesterday we broke above the 200-day moving average, well, just for the Dow Jones and the Russell 2000, is emerging evidence that supports the bullish case that we presented last July 13. So this is something that we're also keeping track as part of our framework. Obviously, another thing from a bottom-up point of view is that when we presented the July 13 bullish investment thesis, this was during earnings season in the United States. And the concern during that time was that an earnings recession would be the next catalyst, or would be the next catalyst for the next shoe to drop, as most of the bears said, right? And I think what we've had now, with the benefit of hindsight, is that if you take a look at the totality of companies that presented earnings that missed consensus expectations, you'll see that on aggregate, these stocks even gained, if you average the performance of companies that missed earnings expectations. So this is something that is also very important as part of the mix, because it shows you that earnings, at least, wasn't the catalyst to stop the rally that we've had since the June 2000 low. So that is pretty much the first part of our bullish investment thesis. So we said, from a bottom-up point of view, leaders are now moving, and 1 month later, as of today, we're now seeing the generals, we're now seeing the soldiers, the infantry, the lieutenants and the colonels start to follow the generals in what appears to be a healthy breadth advance for the US stock market so far, right? So that's point number one. And so far, that's firmed up nicely since the July 13 low. The second thing that we said that was the second subpoint of our bullish investment thesis was that the PSCI and cryptocurrency in particular were both at key major support levels. The PSCI being at the pattern low, meaning if you look at the 2-year chart of the PSCI, it was at the previous low, right, at 6,150. Not only that, cryptocurrency markets were at the 382 fib retracement. Fib retracement as it relates to the COVID low last March 2020, which is where the wave 3 of the advance began. And what we said was that 382, as it relates, or what we said in Open Journal, is that wave force, as it relates to wave 3s, from a major probability point of view, and I looked up this statistic, it's around 70% of the time, wave force typically hold above the 382 Fibonacci retracement relative to the wave 3 advance that we had. And while that was not a certainty, that was a major probability that we could take and put it in the mix for our bullish investment thesis, given how past wave force typically held at the 382 relative to the wave 3. Not only that, we said that best case, we ended wave 4 and we're now beginning wave 5, which is typically with the 382 typically serving as a turning point. Worst case scenario is that we were in a B wave, in a bear market. Why? Because B waves after an A wave in a bear market typically also start in the 382 retracement in relation to the prior advance. That's what we said last July 13. Now that we have the benefit of hindsight, we've now moved towards a more firmed up bullish stance. Why? Because we had nice impulsive action off the support levels, right? You had vertical moves that we saw during the last 1 to 2 weeks, which are evidence of wave 3 advances. As opposed to, if we had choppy, overlapping kind of action, then that would have been characteristic of a bear market counter rally. But we're not seeing that. In fact, every piece of technical evidence so far has been pointing to a wave 5 advance in crypto and a beginning of an up move in the PSCI market. And that's precisely why after July 13, Wednesday, when we called a risk on call for crypto, on July 20, Wednesday, we raised the risk on flag for both Philippine equities and US equities, right? So on top of the impulsive action of the support levels, the vertical wave 3 moves that rarely give a gentleman's entry, we also saw evidence of a break of the channel resistance, right? So if you come off the low of the June lows, particularly if you look at charts like Ethereum and other cryptocurrency charts, what we saw was a a broad-based break of the channel resistances. And this is important. Why? Because if cryptos and even the Philippine market, Philippine individual issues were only in corrections, then majority of them should have been contained inside channels. Why? Because corrections are typically ABC moves where A tends towards equality of C, thereby contained by channels. But since we saw a breakout of those channels in OJ, we call those E4s, then that is the evidence, further evidence that continued to give us conviction in or increase our conviction over the last 4 or 5 weeks. So the third subpoint that we presented was from an Elliott wave point of view, which is part of our process. Last July 13, we said that one half of our model, so for the S&P, for Philippine Stock Exchange, and for cryptos, we always try to stay on top of the Elliott wave models that we maintain as the highest probability path for the markets. And last July 13, the model was split into a bullish and a bearish model, at least for the S&P 500, which we outsource with trading analysis care of Bennett Tyndall. And during July 13, half of the cycle was already showing that the low was in, with another half of the cycle showing that there was one last leg down. Obviously, this was just one subpoint. All the other subpoints, there are 7 of them here, were already showing risk on evidence. And that was July 13. For the last 4 to 5 weeks, as you guys know, we've updated this subpoint to July 20, saying that the top 2 cycle counts are now bullish. That's for the S&P 500. And not only that, recently we've had a wave 4 off the low, and with the 0382 must hold wave 1 overlap in validation. So that's actually where we are right now. I'll go into those details later with respect to the Elliott wave picture, right? So here we are. This is now the bullish Elliott wave count that we've maintained for the last 2 to 3 weeks since we turned, since 100% of the model pretty much pointed to a bullish upside in US equities, therefore confirming the upside in crypto and Philippine equities. So that means that coming from the COVID low, we had a 5-way move up, and then we have a WXY down. That's one scenario. The other scenario is that we have a 3-wave, wave 1 up, and then we have a 3-wave, wave 2 down as a beginning of a terminal diagonal. So those two are pointing to new all-time highs come 2023 for the S&P 500, which is where we are with respect to our outlook and our forecast based on what the data is showing currently. And if we break it down to the daily chart, what we're seeing now is impulsive action off the low. So this is a chart that we presented last week or 2 weeks ago. And it shows you, we presented last week that either one, we have a choppy August before moving higher. Why? Because on a day-to-day basis, we're now experiencing the basis of wave 4 of wave 3. And then after wave 3 completes, we will be experiencing green wave 4. So that represents the choppiness, at least for the balance August, early September. And we said, or number 2, we move already higher from here. Now, if we update that picture, and this is really where we are today with respect to the Elliott wave cycle, right? So if you follow my arrow from the all-time high on the upper left-hand chart of the S&P 500, that's the all-time high that we had sometime around 6-8 months ago. You'll see that since then, at least personally, I've been so I was tracking originally 2 counts. First was a 5-way move off the low, which since then I've completely put on the back into the closet, right? So what I'm currently tracking is really the green count, which is a WXY off the low. So don't ask me about why the channel, why the DCS fits a bearish picture. So I'll go into that maybe in another time. but that's really what you see in a terminal diagonal, which is the context that we have in this chart in front of you. So we're tracking a WXY. And not only that, what I want you guys to focus on is the right side of this picture, right? So coming from the low that we had last June, if you follow my arrow, we had a move off the low. That was an impulse move, a five-way move. That's very clear. And then we have a correction over here, right? So since then, we've had a third wave advance, a very clear third wave advance. It's not a C wave. And the reason for that is because we broke above the channel resistance, evidence number one. Evidence number two is that we broke past the 1 fib extension, which is typically a stopping point for a correction. This is the red resistance line over here. Typically, corrections stop over here, right? And what we have right now is an impulse wave that is already past the 1.618 extension. In fact, based on historical behaviors of impulse wave, I would classify this as a relatively stronger impulse wave, because wave 3 pa lang, a typical stopping point for wave 3 is the 1.618, but we are already past that 1.618. Not only that, we are past the previous high resistance over here. But what I'd like to bring your attention to today is my S&P notes here, which shows you that we are now at a confluence of 3 important resistance levels. Now, what are those 3 resistance levels? Number 1 is this downtrend resistance line over here connecting the high and the lower high. So we are now approaching that over here. Not only is that a major resistance, but we are also at the 618 reverse fib retracement resistance, represented by the blue fib study over here. You'll see that if you draw a reverse Fibonacci retracement coming from the June low all the way to the all-time high that we had 6 to 8 months ago, you'll see that we are now, or we reacted off the 618 fib retracement, right? We reacted off the fib retracement. Now, I didn't include the bearish divergences, the 2 bearish divergences that you'll see on the RD chart. You can just check that by yourself. But the third resistance that I'll point out is the 2 fib extension, represented by the red fib study over here. Why? Because impulse waves, 80 to 90% of all impulse wave typically tag the 2 fib extension level before it bases out, before we get a corrective pattern, and then we get the continuation of the up move, right? So what we're tracking for now, which you'll see here in my SPX note, is that after a 1, 2, 3, this is evidently a third wave. We broke above the DCS resistance. We're past the 1.618, past the 1.1618, clearly impulsive, clearly third wave action. Then right now, what we're looking at is a wave 4 base of this wave 5 completion, which means that if we don't stop here, which is a major probability, whether we stop here or maybe we even stop at the 2.618 OGK, then what we will have after is really a wave 4 kind of base, right? And this wave 4 kind of base is something that we can leverage on to be able to further validate or invalidate our bullish investment thesis. Why? Because as we get the turn in the S&P 500, a wave 4 base typically retraces 382, or let me rephrase that, 70% of all wave 4s will retrace maximum 382 fib retracement of the prior wave 3, which means that you can use that evidence point for the major probability. to anchor yourselves on the major probability side of the market, right? Meaning when we get a turn from the S&P 500, whether it stops at the confluence resistance that I pointed out or much higher, which is a minor scenario, then what you simply do is you draw a fib retracement starting from the July 13 low. And then keep in mind that 70% of all wave fours stay above the 382 support, right? And then not only that, so if it breaks the 382 fib support, then that's when your spider senses start to tingle, right? Why? Because I'm assuming that you guys are holding positions that you bought coming from July 13, 14, 15, when we started to recommend progressive exposure already, July 13, right? So if you're the type to just who wants to hold through the move since July 13, then the trade plan is simple. You hold it through the wave 4 base, and then just actively hold, meaning actively monitor the wave 4 base, see if it holds above the 382. If it breaks the 382, spider sense tingle, and then you watch it even more closely. Maybe you trim a bit, maybe you look at your holdings, see if any issues are breaking above the key trading moving averages, trim the weak ones first, hold the strong ones. And then what will completely set off, maybe not the spider sense, but will set off the Avengers alarm, will be the overlap of the wave 1 high, right? Which is what we had over here. If you follow my arrow here, that's the wave 1 high. Why? Because obviously we're tracking this as an impulse move off the low. And the rule is that a wave 4 base should never, and I repeat, never in the history of financial markets has a wave 4 base overlap with a wave 1 high. That is one of the 3 cardinal rules of Elliott wave. And that is something that if it happens, if and when, not when, but if it happens, then that single evidence point collapses our bullish investment thesis that we presented last July 13. Now, obviously, you don't wait for the overlap before selling all of your positions. It starts with a progressive, the opposite of progressive exposure, progressive trimming. Let's say if it breaks below the 382 fib retracement. So that is what we're tracking for the S&P 500. If you want something that you can pair with the S&P 500 to be able to track, to see if this risk on bullish thesis continues to firm up, you can actually take a look at the SMH, which is a bullish inside of the S&P 500. This is the semiconductor index. And what you will see here coming from the all-time high is a correction that was bounded by a DCS or a channel. That was a very clear ABC with a fifth wave of the C being an ending terminal diagonal. And then what we have off the June lows is a very crisp and clear 5-way move off the low. You'll see here, look at my arrow, you'll see a 1, 2, 3, 4, 5, very clear. We presented that last week. What you'll see the new thing that you'll see today is that we had a rally coming from an initial correction, which was an A wave of a corrective pattern. We had a rally that was strong enough to rally all the way to the previous high, right? And what that is that it's a B wave of a sideways corrective pattern, or in Elliott wave terms, a sideways of a flat. In classical TA terms, it's a sideways rectangular pattern. And what that tells you, even from a classical point of view, is that from a classical point of view, you'll see a C wave going down over here to complete the pattern, to complete the C wave of the pattern. So coming from the first high, you have an A, B, C wave going down, right? You have a C wave going down. And from a classical technical analysis pattern point of view, that is what you want to see, a C wave that will hold here inside the box to make the right shoulder. I repeat, the right shoulder of this inverse head and shoulders pattern. Not only that, if we get a turn of the right shoulder, then you'll see a breakout of the neckline with a minimum breakout target based on the size from the head to the neckline all the way to the previous all-time high for the semiconductor index. So if you're wary of the bullish investment thesis that we've been presenting last July 13, then don't let worry bog you down, but rather lean on to the weight of the evidence. And for me, what it boils down to are really the hourly charts of both the S&P 500 and the semiconductor index, right? So obviously the semiconductor index is doing a C wave of its first corrective pattern after its first impulse wave. The S&P 500 is pretty much doing a wave 4 base of the impulse wave of the low. So you'll see that the SMH is slightly ahead of the S&P 500 with respect to the bullish investment thesis that we've laid out last July 13. So what this simply means, going back to the title that we presented at the start of this presentation, is that if today is August 16, right? If today is August 17, pardon me, then for the balance of August, possibly even up until early September, then you're going to see at least some pullback or some volatility. Volatility meaning a euphemism for a pullback, at least in the S&P 500 and US equities, maybe a pause in Philippine equities, possibly even in crypto, before we follow through higher come maybe early September to around mid-September onwards. Now, obviously here, I am assuming that as the S&P 500, as the SMH pulls back, you're going to see a correlation with the PSEI and the cryptocurrency market. Obviously, that's not always the case. We know that crypto leads the S&P 500. Therefore, just because we're pulling back short-term doesn't mean I'm going to go all cash. For a lot of issues that I bought last July 13, I'm just going to hold them. Through the basing pattern. For issues, strong issues that I'm trading, strong issues that I have, maybe weak issues that I have that are maybe below the 20-day, maybe I'm going to reallocate them to stronger issues, because definitely there are going to be sore thumbs, meaning leaders that will stick out over the next 1 to 2 weeks, particularly in the crypto market as US indices pull back from resistance levels, whether they pull back from here or whether they pull back from the 2.618 extension, which we pointed out for the S&P 500. So that's for the Elliott wave picture. And that's what it really boils down to, at least how I'm looking and tracking at the markets and how I'm actively holding our investment positions, how I'm actively holding positions that were bought last July 13, 14. Yes, we're going to see some volatility, and that's going to bring out a lot of the bears, a lot of the worries that we're initially calling that this was just a bear market rally, that that the Fed is going to continue to tighten all the way till inflation reaches 2%, and that's going to cause a depression. That's going to cause markets to really significantly move lower. Well, that is the narrative that may come out once we get this basing pattern. It's very important to stay on top of the evidence, and the evidence so far is telling us that markets are just going to pause here in a wave 4 base as long as they stay on top of the 382 previous low for the SMH before we continue higher through September all the way to Q4. At least that's what the evidence is pointing to at this point in time, right? So we'll go through the other subpoints of our bullish investment thesis. Number 4 is obviously the macro area of our process. And last July 13, we said, at least in the macro space, is that we are already seeing a pullback in commodities, right? Commodities being a major cost input to the inflation inflationary narrative, right? So last July 13, we pointed out that if you track a lot of the commodities, copper, industrial commodities like nickel, pretty much all the hard commodities, excluding oil, which is now already starting to turn lower here in what looks like to be a head and shoulders pattern breakdown. Not only that, if you track soft commodities back in July 13, those were already starting to break below their trending moving averages, the 20-day and the 50-day. And that's why we already said last July 13 that inflation being the reason for the Fed to tighten, which was in turn the reason for the market dropping, inflation was already coming off last July 13. If you look at the leading indicators of inflation, we said that that had already peaked, at least in the short term to medium term. And what you see here is a chart from Jim Bianco of Bianco Research, and it shows you that this is pretty much where we are right now, right? So the reason why we rallied the last 4 weeks is because we started to see inflation come off, right? 9.1% for June, that's using the CPI. And then for the July inflation print, that was 8.5%, showing the first month-on-month drop in CPI. And not only that, if you want to look at inflation, there's this really cool tool that the Cleveland Fed uses to track inflation in real time. It's called the Nowcast, right? And the Nowcast, as of last week, is actually already pointing to CPI, which is the measure of inflation, which is the most tracked measure of inflation, already moving to 6.2 this Q3, right? This Q3, meaning end of September. So this is pretty much the three paths that the Cleveland Fed's Nowcast is already showing. It shows you that 8.5%, and it shows you that over the next 1 to 2 months, all the way until the midterm elections in the United States, it shows you that at least CPI is already starting to come down to more sustainable levels. Now, to give you guys the big picture, from 2000 all the way to 2015, at least over the 15-year period, inflation was pretty much hovering below the 2% area, that was CPI. And then since the post-COVID low, CPI has gone up significantly all the way to 9.1%. And now that you have that big picture in mind, 2% for like 10 to 20 years, 15 years, all the way to 9.1%, which was really the cause for all the tightening, which brought down all risk assets. We're now seeing that CPI print go from 9% to what if you just look at the TNX chart, which is a measure of inflation expectations, we don't see that going all the way back down to 2%, but rather we see inflation moderating to the 50% fib level, at least maybe 618 fib level. That shows you to maybe around 4, 5, 6%, that area over the next 1 to 2 years, right? So with inflation coming down, so that actually puts some brakes on the catalyst that has caused the market to go down, which is the Fed tightening, right? So this is something that's constructive, and this shows you that the inflation print, the month-on-month decrease that you saw, which came out, I think, last week or a week and a half ago, was not a one-time thing, but this is actually something that we'll see sustained over the next few months, right? So this is TNX. This is the TNX chart, which is essentially it shows you the chart of the 10-year bond of the States, but what it simply means is that the TNX is a reflection of inflation expectations, right? So that's really what it means if you want to look at the chart. And using our open journal system and process, you'll see that we have a complete 5-wave up move all the way to the 1.618 fib extension, right? 1.618 fib extension, which coincidentally is also the previous cycle high in 2019. That was before the Powell pivot in Q4 2018. Q4 2018, that's correct. That was before the pivot in Q4 2018, which which was the cyclical high in the TNX back then. So since then, we've had a five-way move off the low. And what's important to note here is that you have a high, higher high with a high, lower high in your RSI. And this is a weekly chart, right? And that tells me that it doesn't tell me, it only gives me conviction that after you have a bearish divergence on the weekly, at the minimum, you're going to see a corrective pattern that will be maybe over a few weeks, over let's say at least a month or two, right? Because it's a weekly bear div. And to me, that corrective pattern at best, at corrective pattern, that's one extreme. That's one end of the spectrum. The other end of the spectrum is that we already completed a five-way move, right? And then we're now doing an ABC for inflation expectations, right? Behind a drop in oil prices, which is pretty much what we're already seeing, what we've seen over the last 2 to 3, 4 days, which is obviously a material portion of inflation, right? So that's what we're seeing, at least for inflation. That looks like to be coming down. And that is supportive of our bullish thesis, which is new all-time highs for the S&P 500 by 2023 in a terminal diagonal scenario to complete the cycle that started since the 2009 low, right? So that's the TNX inflation expectations. So that is the macro pullback. So that's subpoint number 4. We saw a pullback in commodities suggesting that inflation already peaked. And then the last macro point that we presented last July 13 was that as a catalyst to this bullish investment thesis, which typically comes midway in a cycle, in the wave 3 of the cycle, and that's essentially what turns sentiment from negative to positive midway. We said last July 13 that if you look at the math of the US fiscal situation, that, and based on the work done by Luke Groman of FTTT and Larry McDonald of Bear Traps report, that gave us the conviction to say that we're going to see a full Fed pivot by Q3. That's what we said last July 13. Not only that, we did point out that similar to the Billings Code, you can't get to a yes to a no without a maybe in between, right? What we pointed out was that the Fed would not go from, Paul Volcker, Lodi ko si Paul Volcker tightening to a complete pivot. We did mention that in between, they would move towards a more data-dependent path and away from the forward guidance, which is already what we saw during the last July FOMC meeting. And that was really the catalyst for the turn, the wave 3 turn in the impulsive turn higher, right? So, so that was July 13. So that turned out very well for us in terms of calling that the Fed would move to a more data-dependent position, which is what they did. So now, at least what's remaining for the Fed as our primary catalyst is that we see as a primary catalyst for a bullish investment thesis is a full Fed pivot come August 26, 28. That's a Jackson Hole meeting. I would actually put the higher probability more on the September 20 to 21 FOMC meeting. Why do I put it there? Simply because we're looking at a wave 4 base for the S&P 500 starting today, and it doesn't seem, August 26 to 28 seems a little too early for me as a catalyst for that wave 4 base in the S&P 500 turn out, or even let's say the C wave in the SMH turn out. So my guess would be maybe 1/3 chance we'll see the full pivot August 26, 28. I'd say 2/3 chance we see it September 20 to 21, right? Or at least Powell not doing a full pivot, but rather a full pause in the rate hike cycle, right? So I think that would be a more reachable position, which I think would be enough of a bullish catalyst for markets to go higher. So that's really our working model that we have. At least these are the subpoints that we pretty much pointed out last July 13, and we're monitoring all the minutiae of these subpoints, right, on a real-time basis. Why? So that because as we've been holding our investment positions since July 13, we're continuing to track the investment thesis to give us the confidence to hold through the volatility, to hold through the basis that that we have during this impulse move higher, right? So with respect to the Fed macro point, we show this path, or we show this chart already the last 2 weeks, showing that every time they gave projections, pretty much the last decade, which is shown in the colorful lines over here, the gold, the teal, the purple, the orange, and the red. Every single time they had to go against their projections, meaning their forward guidance, and eventually increase the balance sheet, right? So we think that's going to happen eventually, a full pause this Q3, possibly resume QE sometime 2023 already, right? And the simple reason for the pause call in the Fed, eventually a pivot come 2023, is that simply by looking at the US fiscal situation. And the simple math of the US fiscal situation is this blue line over here, which represents the 3 largest expenses of the United States government. That's your treasury spending, meaning that's your interest on the debt, right? Second is that's your entitlement pay-goes, right? So these are your top 2 expenses, right? So that's treasury spending and your entitlement pay-goes. This is your 401ks, your Medicare, Medicaid, and the benefits of the retired people, your pensions, right? And what this shows you is that these 2 are already close to 120% of total tax receipts of the United States government, which means that if it's 120%, then that 20% needs to be funded by QE, needs to be funded by the US Treasury issuing bonds, and that being the Fed doing QE, since there are no more buyers of US Treasuries. So obviously that number came down to around 100%. And to me, what's very interesting is that if you just do the math on what the US is spending versus tax receipts, and I didn't include it here, but last month, July, you already saw tax receipts come down in certain states. New York, California reported tax receipts. Those went down already, meaning revenues of the US government is going like this, right? And then expenses, which are already high. So revenues of the US government is going down like this, and then expenses of the US government is going up like that, right? So if you just do the math on it, US has around 3 trillion in debt. If it does 75 basis points increase by the Fed, which it did during the last 2 sessions, then 75 basis points of 3 trillion is somewhere around $225 billion of added interest, added expense. And if you just look at the size of the 225 billion, which is the increase in interest expense on the debt, 225 billion is already 30% of the United States' largest expense, which is defense at $700 billion, right? So that's the largest expense item on the budget of the US government. That's $700 billion, which they spend on defense. And if they raise interest rates by 75 basis points, that's already 225 billion. So they did that twice, that's 500 billion. That's already 80%, 70 to 80% of their largest expense. That's all in good if they're able to really, print the deficit, meaning monetize the deficit. But what's been happening is that central banks around the world have stopped buying US Treasuries. We're now seeing, obviously, hedge funds, investors start to buy US Treasuries in preparation for a recession. I think that's really why they wanted to tighten rates and to really scare people into a recession. It's really to make the US Treasury market liquid, because that's their number one job, right? But we won't go into the details of that. The point is that the whole, if you just take a look at the US fiscal situation, which nobody has looked into during the last pretty much half century, because that's never been a problem for the United States, then you'll see, or you'll be able to make a strong case that the Fed was never in a position to keep hiking all the way till end 2023. And the first cut being 2024, which is what their forward guidance, which is what the first dot plot was pointing to, right? And that's precisely why we didn't fight the Fed, but we rather front run the Fed, which is, there's a fine line between the two. And we thought that there was a policy mistake for them to keep tightening, and that they would eventually pause and pivot. And staying ahead of the curve of the Fed is, according to Stan Druckenmiller, is how you make the most money in markets, right? And that's what we've tried to do, at least since July 13, when we looked at the math, looked at the numbers, and said, no, the Fed can't do that. They'll eventually pivot. And you look at history, history is pretty much supportive of a pause and a pivot as well, right? So don't follow what the Fed says, follow what they do, follow their actions, follow what they've always done over the course of history. And the reason why it was very important to follow the Fed and the potential move to data dependence and eventually a pause and eventually a pivot come 2023 is because the Fed is pretty much the number one driver of liquidity, right? And liquidity is the number one driver of the cryptocurrency market, right? As shown here, chart by Delphi Digital, crypto market is the most levered bet on global liquidity. And the reason why crypto is the canary in the coal mine is because it is the most leveraged bet on global liquidity. And the reason why we track liquidity is simply the quote by Stan Druckenmiller: earnings don't move the overall market. It's the Federal Reserve Board, focused on the central bank, focused on the movement of liquidity. Most people in the market are looking for earnings and conventional measures. It's liquidity that moves the markets, right? And if you've been with Open Journal for quite some time, I would argue that you won't find another local service that has better tracked the twists and turns of the local market better than Open Journal. And that's simply because we don't look at the macro factors. We don't look at remittances. We don't look at demographic dividend. We don't look at BPOs. We don't look at Philippine GDP. All that's noise. The only thing we simply look at is liquidity by the Federal Reserve of the United States. And most of you asked me this question many times in the past: what the hell does the Federal Reserve have to do with the cryptocurrency market, more or less the Philippine market? And the reason is simple. The US, while they account for 20% of global GDP, the dollar accounts for 87% of all transactions that happen globally, right? More so the Philippines, because the Philippines, more than half of the value traded in the Philippines comes from hot money. That's versus a 20 to 30% average in the Southeast Asia or the Asian market, at least for the last 5 to 10 years, right? So, so that's pretty much where we are with respect to the bullish investment thesis. What are the potential risks ahead? Obviously, we pointed this out last week. This is an overlay of the current rally that we have today in the white line versus the 2008 rally in the gold line, right? And the reason why we're tracking this is simply to manage our behinds, right? Since we're currently holding in the market, and what we saw this week, meaning the move above the 200-day, both for the Dow Jones and the Russell 2000, was important evidence against this view, right? And what I'll simply point out is that if this is something that you are concerned about, to me, so let's take a look at this picture first, right? So this is a bear market. This is a study that suggests that what we have right now is a bear market rally. And if this is a bear market rally, then the narrative to an eventual move to all-time lows would be, let's say, if you look at if liquidity is what moves the market, then obviously the narrative, the catalyst will be, if you look at the Fed, if you look at who have been the historical doves, you have Kashkari, Daly, Evans. These guys have now turned hawkish. That happened just last week. So normally when doves shift hawkish, when the most dovish members of the Fed move hawkish, then you need to pay attention. Not only that, William Dudley, who's continually been very vocal in the Wall Street Journal last week, and obviously months before that in his op-eds, have highlighted a hawkish path for the Fed. And number three, if we do get a more hawkish stance by Powell in his speech, more hawkish than what equity market expectations are reflecting with the current rally that we're having, then obviously that's going to bring down markets first below the 382 and eventually below the wave one overlap, right? And that's really what it boils down to. Over the next 1 to 2 weeks, what our bullish investment strategy boils down to is really looking at the 236. Once we get the turn in our wave 3 portion of this impulse wave off the lows, then just make a fib retracement. We'll look at the fib retracement and focus on the 236 support, number one. Focus on the 382 fib support, number two, because 70% of all wave fours hold above the 382. And then lastly, you have a wave one overlap, which is where the Avengers alarm comes off, right? 382 is when your Spider-Man tingles start to come off. Minor alarm, wave one overlap. So 236 minor alarm, 382 major alarm, because that's obviously where the major probability shifts. Wave one overlap is a complete Avengers alarm. Thanos is invading the Earth. It's now do or die. It's now time to say bye-bye to your bullish positions, right? So that's really where we are right now with respect to the S&P 500. For the SMH, what it boils down to is really the 236 holding, right? So that's 231. You also have a 222 and the previous low. So that's also what you want to see hold. You want to see bullish divergences in the 15 and RD charts on those levels, on these aforementioned levels. And then what you want to see is a vertical move off the low, possibly end August, maybe mid-September, thereabouts, right? So that's pretty much where we are right now. Now, I think the question now is that, okay, since we're just basing out in a corrective pattern, and even while this happens, you might have some sore thumbs start to stick out, generals that will eventually be leading the next up move, then where do we want to focus on? So my suggestion is obviously you guys still have to do your charts. My focus is to focus on the ETH and the ecosystem around ETH, right? And the simple reason for that is we have upcoming catalysts. You have the merge, which was moved earlier to September 15. And before the merge, you have a fork happening between ETH and ETH-PO, right? Meaning the proof of work, ETH proof of work. And so you have Ethereum, right? Which is clearly outperforming BTC. And if you look at the ETH BTC chart, you'll clearly see that after an inverse head and shoulders, we had an impulse move off the low. And then we had a correction that happened bounded by this blue channel area over here. And since then, we've broken out of that. And it tells you that over the next weeks and months, Ethereum will continue to outperform Bitcoin, right? And we're at the 1382 extension. Impulse waves typically tag all the way, not just the 1.618, but all the way to the 2 fib extension, which is coincidentally where the previous all-time high is. And that's really what we want to see. That is aligned with our bullish investment case, at least starting today or starting July 13, all the way maybe until end 2022, early 2023, which is when we think prices will continue to move higher, obviously with a pause over the next few weeks. And I think around Ethereum, it would be very helpful to focus on the Ethereum ecosystem. What do I mean by that, right? So around Ethereum, which is obviously outperforming Bitcoin, which is characteristic on a fifth wave. In a fifth wave, it's really your emerging blue chips that outperform your blue chip. In this case, Ethereum outperforming Bitcoin. And around Ethereum, you're going to see ecosystems or protocols that are built on Ethereum, such as Synthetics, which is basing out in an E3 post inverse head and shoulders breakout. We recommended that last week as well. So this looks like it's approaching an E1 of its short-term base. You have Gala, which is an NFT gaming ecosystem on Ethereum and the Binance Smart Chain. That looks like it's firming up and looking to follow through higher after a breakout of a bottom pattern. And it's now, I think, coming off a 180-degree hit and run setup, right? So that's Gala. And then you have Polygon Matic, which is really the scalable solution for Ethereum on the layer 2 level with its ZK rollups that are Ethereum compatible. So that just recently came out. And then lastly, you also have Optimism, which is also what we like, not available in PDAX, but it's available on Binance, right? Which is a layer 2 scaling solution for Ethereum. So that's recently been gaining a lot of TVL, that's total value lock. And I would suggest that you guys just simply use this link to just see where the Ethereum related ecosystems are. So these are the 4 that I will be pointing out for now. So so I'll point these 4 out. You can also add GMT to that, which looks like it's pausing before I'll follow through higher. So I'll keep the list limited for now, given that we might see, given the outlook that we have for the S&P 500 and the SMH. And then we'll come up with maybe a better list over the next few weeks. But at least for now, the focus for me would be strong issues that are bucking the trend, right? So you can simply look at these issues. The strongest issue that looks to me right now looks like Ethereum Classic, maybe even Chiliz. Chiliz looks like to be the strongest issue right now. If you guys have suggestions for strong issues, let's just place them in the Discord. Other than that, these are the 4 issues that I think are setting up nicely, with the exception for Polygon, right? So Synthetics approaching an E1, Gala looks like it's really pausing just above the 10-day before it follows through higher. GMT, I think, is also pausing as well. We started to see volume come in the last 2 days. We want to see some more volume come in, but I think that GMT, after the move the last 2 days, holds above the 5-day or maybe even the 10-day before following through higher, right? So those are the issues that I'm looking at for now. With that, guys, I'll just switch to the Ethereum chart, and then we'll do a quick Ask Me Anything, and then we'll end in 18 minutes. That's 6:30 p.m. as promised, right? So if we look at the Ethereum chart, over here, then what we'll see is, if we take a look at the 5-minute, I put my studies over here, what we'll see over here is a 1-2, and then we have an extension of, we have a 1-2 over here, and then you have a third wave, which is its own extension, 1, 2, 3, 4, 5, to complete wave 3. And then you'll see your OX over here, right? You'll see your oscillator extreme over here, which is what we teach in Open Journal on how to anchor your wave 3 of 3. Your wave 3 completes over here. And since then, we have a wave 4 base. And to me, at least, it's unclear right now whether we already ended, meaning wave 5 already ended here, or we have another move up to the 2.618 fib extension. That's 2,224 Ethereum, right? Either way, we base out already here, together with the wave 4 for the S&P 500, together with wave C for the SMH. So that is something that I'm looking at for Ethereum. How do I know if this is wave if we already ended here, or if we have a wave 5, one more move higher over here. How I'm simply tracking that is this pattern over here, right? So you have a base, head, and a base, right? So if we break below this black support line over here, then we already finished the first impulse wave for Ethereum. We base out, and then we base out over the next few weeks before a follow through higher. Conversely, if this channel holds and then we start to see a rally higher, then that means that we see a sustainable move all the way higher to the 2.618 fib extension. Either way, we are already tracking an end to the first impulse wave of the low for Ethereum. We're tracking to the first end to that impulse wave. And after that impulse wave ends, we're looking at a corrective pattern. And when that corrective pattern finishes, then that will be the time for the next impulse wave higher, which can either be a wave C or a wave 3, right? Which will be a strong move higher, right? So that's how we're tracking Ethereum and the crypto space. And with that, guys,